If you've gone to university in Australia, chances are you've heard of HECS, the Higher Education Contribution Scheme. Simply put, HECS is a government loan that helps students pay for their tuition fees. As you start earning an income after you graduate, you'll have to begin repaying that loan, and I'll touch on the thresholds a bit later in this video. Lately, I have been seeing a number of headlines discussing the potential to eliminate the annual CPI adjustment to people's HECS debts, currently held by about 2.9 million Australians with an outstanding balance totaling around the $70 billion mark. So in this video, I am planning to dive deeper into the topic of HECS as well as the CPI adjustment to provide some greater detail on the overarching topic, with the intent being to bring awareness and potentially explain or allow people who have a HECS debt to comprehend the financial impacts that it can have on oneself in the long term. And I will also share some handy tips on the best way to handle your HECS to ensure that you don't lose money to the scheme in the long run. Firstly, CPI. What is it? It stands for Consumer Price Index, which sounds really complicated, but basically it just measures the price changes for a basket of goods and services over a period of time. In the context of HECS debt, the Australian government adjusts the total outstanding balance every single year to match what CPI is at. And what this means for anyone who has a HECS debt, it means that their total amount owed can increase each year in line with inflation. And the simplest way to understand this little section of today's video is that the cost of a degree 30 years ago is not the same as what it costs today. It's actually much more expensive to go through the educational system to get a degree in today's terms of dollars. So to hold the people accountable who still hold a debt from 30 years ago, their balances would have increased with inflation along the way to keep it as even as possible. So now let's move on to the HECS repayment system. And the way that it generally works is that once you start working after you've graduated, you will generally need to disclose that you have a HECS balance or a HECS debt to your current employer. Then when you start earning a certain amount of money, your employer will withhold a percentage of your income with the intent for it to be put towards that outstanding HECS debt that you hold. This percentage is based on a threshold set by the Australian Taxation Office, which can be found on their website. For your reference, here are the 2022 to 2023 HECS repayment income thresholds and rates. You can also scroll down to find previous year's thresholds and rates as well. Now with context out of the way, here's where the conversation really begins. You can make additional contributions to your HECS debt at any time throughout the year. However, the mandatory amount that you must repay that's withheld from your employer does not come off your balance until the very end of that financial year, where they then apply the CPI adjustment. And in my opinion, this is quite unfair for several reasons. Reason number one being that students who have finished their studies and started to earn income may have to wait all the way through the year to the end of the financial year to actually start making repayments to this debt, even if they are willing and able to start making repayments sooner. The second reason why I think it's unfair as well is that the CPI adjustment takes place at the very end of the financial year on the total outstanding balance. And the kicker here is that it's calculated at CPI across the entire year. And I'll try and make sense of it by just putting it very simply. The CPI rate, if it increases every month at different rates and it increased quite sharply later in the year, the student who could have been making repayments every single month through this mandatory system would be paying far less interest over the course of an entire year if the system worked in that way, which lots of banking systems definitely do. I don't understand why the CPI adjustment is so different. The point I'm trying to make is that the student would be at a disadvantage if CPI fluctuated month to month very greatly, because it would be overall at the end of the year when it's applied, not in their favor. It would end up costing them more in interest. The impact of CPI can be very significant, as we've seen throughout the COVID-19 pandemic. In 2022, the CPI adjustment was 6.5 times higher than the previous year due to high inflation. This means that those with sizable HECS debts may have had large sums added to their outstanding debt as a result of the adjustment. And reason number 3 of why I think it's relatively unfair is that some would argue that withholding repayments until the very end of a financial year and then making an adjustment to that balance based on that total that hasn't been withered down throughout the year is not within the principles of fairness and equity. And this is because students who may be in a position to make voluntary contributions throughout the year are actually subsidizing it for those who are not able to make those contributions throughout the financial year. So it's really not fair on those who are trying to do the right thing or those in a position to do the right thing. It's actually still working against them. So let's explore what your options are to make sure that you are optimizing your situation as best as possible. The first thing to check is whether or not you are in the final stages of paying your HECS debt off. This is generally within 2 years or so that you would be expecting to have a balance of 0. To avoid getting hit with a CPI adjustment, especially if the percentage that year is going to be very high, I would definitely encourage you to consider making a balloon payment to entirely pay it off if you are in a position to do so. Just as a note, the cutoff date is June 1st at the moment every single year. So make sure that you do it a couple of weeks earlier to make sure that that payment goes through in time and that it's not delayed due to processing. And then when you do your tax return, you should receive most of the money that was being withheld by your employer for your HECS debt back, assuming that you don't have any other outstanding debts owed to the ATO. The second option you have is to tell your employer, hey, please stop withholding my HECS repayments from my take-home pay. This is not widely known and it's generally not encouraged, but if you're pretty financially savvy, it's something that definitely should be considered. Important to note that this is not illegal by any means at all, and you will have more money in your pocket each time you are paid because they're not withholding a percentage of your pay every time you're paid anymore. Where the advantage would be to have that money parked in a high interest savings account if you don't have something like a mortgage to earn more interest throughout the year, and or if you did have a mortgage, put it in an offset account and let it sit there throughout the year to save you from having to pay the bank interest as well. It's a win-win in both of those scenarios. The downside is that you need to be responsible with this money and make sure that you have access to it because you will still owe that money as a mandatory repayment come tax time. It's just you will have the prolonged period of an additional 52 weeks throughout the year of building that income in an account that is working for you instead of being in an account that is working for your employer or the government. The one thing I will say for this hot tip is that if you are not financially savvy or responsible, definitely avoid doing this. The mandatory thing was probably put in place for those who are not too good with their money. If you are good with your money, be very smart with your money and make it work in your favor. To wrap up, if you're not sure how to check your outstanding HECS balance, just go to the MyGov website, click on the ATO link, and then it should be displayed on the main page when you get there. And there you should find a link as well that will take you to a fully itemized chart of basically everything that has been charged or taken from that account, being all of the subjects that you've studied will be charged against each year that you've studied, and that will build your balance up. And then all of the money that's been contributed by your employer through mandatory repayments, if you are repaying your HECS at this point in time, you'll see all of them coming off that balance as well through that link. Overall, understanding the CPI adjustment and how it works hand in hand with your HECS is pretty important to understand because for some, over the past couple of years at the time of recording this video, they would have had thousands of dollars added to their balance simply because inflation has been high. We've had very high years where these percentages have been hitting their accounts hard. If you have anything upwards of $10,000 or more, you're adding hundreds, if not thousands of dollars to that balance or that outstanding balance over the course of a single year. For some, it might actually be more than what mandatory repayments actually cover. By being proactive and taking advantage of the opportunities to optimize your HECS debt, you can reduce the financial impact that it will have on your overall finances. And that's an important thing to definitely understand. Whether you're getting close to paying it off in full, or you're just starting to pay it off right now, or you're thinking about going to uni and just trying to learn a bit more about this very generous scheme that the government offers for our Australian citizens and our education, it's something that is well worth understanding because if you optimize it, you should be able to use the additional funds that you have to be put towards something else in a way that allows you to work towards achieving other financial goals. And that is pretty much all I really wanted to talk about today. So if you did enjoy today's video, if you learned something, please consider hitting that like and subscribe button down below. I really do appreciate the support, and it definitely goes a long way for the channel. And I will pretty much leave you there. Have a good day, have a good week. And as always, I will see you in the next one. Bye for now.